Welcome back, my awesome people. In today's episode, I will be highlighting the popular trend of diversification. Now, we've all heard of the financial experts describe the benefits of portfolio diversification, and there is some truth to it. A personal stock portfolio needs to be diversified to help lessen the inherent risk of holding only one stock or only stocks from one particular industry. However, some investors may actually become over diversified. So, what is diversification? Well, diversification is owning different stocks within different industries for the purpose of helping investors reduce the risk of owning individual stocks. Diversification is all about spreading your investment dollars across several asset types. In order to do so, you'll need to know what asset classes are available to you, both in terms of traditional and alternative investment vehicles. Traditional investments include domestic and international stocks, fixed income assets like bonds, and investment grade funds such as mutual funds and ETFs, real estate, precious metals, and currency. Whereas alternative investments include art, crypto, and tax liens. Most investment professionals agree that although diversification is no guarantee against any losses, it is a strategy to adopt towards long-range financial objectives. There is little difference between owning 20 stocks and 1,000 stocks, as the benefits of diversification and risk reduction are minimal beyond the 20th stock. And owning more stocks than necessary can take away the impact of large stock gains and limit your upside. When we talk about diversification in a stock portfolio, we're referring to the attempt by the investor to reduce exposure to risk by investing in various companies across sectors, industries, or even countries. There are many studies demonstrating why diversification works. By spreading your investments across various sectors or industries, you reduce price volatility. This is because different industries and sectors don't move up and down at the same time or at the same rate. If you mix things up in your portfolio, you're less likely to experience major drops because as some sectors encounter tough times, others may be thriving. And this provides for a more consistent overall portfolio performance. That said, it's important to remember that no matter how diversified your portfolio is, your risk can never be eliminated. You can reduce the risk associated with individual stocks, but there are inherent market risks that affect nearly every stock. No amount of diversification can prevent that. And for more strategies and tips on money, investing, and creating financial independence, follow me on Twitter at Jacob Rant and get bullish on that subscribe button for the YouTube algorithm and smash all the likes and bells to get all the updates on my fantastic investments. And comment below with what you think about these growing industries, because I do reply to every comment. And if you're watching this video and do not have a Wealthsimple trade account and you want $0 commission fees that won't eat into your profits, especially if you're buying penny stocks, my Wealthsimple link is down in the description box below, where you will also get 3 free stocks, just like Webull and the other platforms, just for signing up. Link is below. Now, in Edwin J. Elton and Martin J. Gruber's book, Modern Portfolio Theory and Investment Analysis, they concluded that the average standard risk of a single stock portfolio was about 49.2%. However, they also found that with a portfolio of 20 stocks, the risk was reduced by less than 22%. Therefore, the additional stocks from 20 to 1,000 only reduced the portfolio's risk by about 2.5%, while the first 20 stocks reduced the portfolio's risk by 27%. Many investors have the misguided view that risk is proportionally reduced with each additional stock in a portfolio, when in fact, this couldn't be farther from the truth. There is evidence that you can only reduce your risk to a certain point beyond which there is no further benefit from diversification. A person's portfolio should also diversify among different asset classes, meaning allocating a certain percentage to bonds, commodities, real estate, alternative assets, and so on. Owning a mutual fund or ETF that invests in 100 companies doesn't necessarily mean that you are at optimum diversification, because these basket of stocks are sector specific. So owning a telecom or healthcare ETF or mutual fund means you are diversified within that industry. You are not diversified to the extent that you could be investing across various industries and sectors. For example, according to legendary investor Warren Buffett, wide diversification is only required when investors do not understand what they are doing. In other words, if you diversify too much, you might not lose that much, but you won't gain much either. If so much protection is offered through diversification, why is it that some of history's most successful investors are against it? As much as a good mix of assets across multiple classes protect your portfolio from extreme losses, it can also hinder your portfolio from tremendous gains. There's a lot that we can get from Buffett's statement. First and foremost, diversification is essentially a form of insurance. While it provides protection from tremendous declines, it can also be quite costly when specific stocks make incredible runs. So, by taking the time to do the research and understanding what you're getting into, you can escape the need to diversify. Diversification is a hot topic that's not met with much debate. Although some of the greatest minds in investing avoid diversifying, it remains important, especially for the beginner investor, because it greatly reduces the level of risk you must accept to participate in the market. Sure, mixing portfolio assets may water down dramatic gains over time if you've chosen a great investment. However, picking that stock that's going to see those dramatic gains is like finding a needle in a haystack. It's easy to look back and say, oh, I should have put all my money back into Amazon in 2006. The problem is that in 2006, with the information available at the time, it would have been hard to trust all of your money to that one company, and nearly impossible to predict that it would grow to become one of the largest companies in the world. The bottom line is that getting rich in the stock market is the result of compounding gains over time. Diversification helps to protect those gains as they work for you. I personally own over 50 stocks. The majority are my swing plays, but for my long-term dividend stocks, I own approximately 11 strong companies that make up my long-term dividend and growth portfolio. Remember, diversification is like ice cream. It's good, but only in moderation. The common consensus is that a long-term, well-balanced portfolio with approximately 20 stocks diversifies you enough. So, do your own due diligence when buying companies and try not to over-diversify your portfolio, because you may not lose much, but you will also not gain as much. And again, if you are watching this video and do not have a Wealthsimple trade account and you want $0 commission fees that won't eat into your profits, especially if you are buying penny stocks, sign out with my Wealthsimple link down in the description box below, and you will get 3 free stocks just like Webull and those other guys just for signing up. Link is below. So again, I am not a financial advisor, so make sure you do your own research and consult your own financial professional. Thanks. There is so much wealth for all of us to get a piece of. So by allowing our hard-earned money make us more money is the key to wealth and the key to financial success. Subscribe, like, and share to help out the channel, and so you will get notified of when I post my penny stocks, REITs, dividend, and speculative stocks from my portfolio and other investments I am currently buying and selling. I want everyone to have the opportunity to get out of this work-life trap by buying back their freedom through investing. So let's all ride together on a journey of health, love, success. So until the next video, stay ranting.